Hello everyone. So today I'm going to explain about the options. What is mean by option? What are the kind of options we have, like different types of option, call option, put option, and what happens if it is in the money, out of the money, at the money, and how much margin is required when you place an order, okay, and how the settlement happens. So I'm going to cover in this PPT all this detail in detail. So let me share my PPT. Okay. So first, the definition of option is like option is a derivative, okay, a contract that gives the buyer the right but not the obligation, okay, to buy or sell the underlying asset by a certain date. That is called expiry date at a specified price, like strike price. Okay, so here in when you are an option buyer or an option seller, you do a agreement or a contract with the other counterparty. Okay, so by this date, like which is called the expiry date, on expiry date at a particular price, I will buy or sell this underlying. Okay, so for this, I if I give you the example of, suppose there is a TCS shares, okay, which is at the spot price or at the current market price at 3000 rupees. Okay, so if you want to buy that share in a normal stock market, you will have to pay 3000 rupees. Okay, but as part of option, you can, and if you believe that the price of that underlying will increase and you will get a profit, but you don't have 3000 rupees in your account, you have suppose 1000 rupees. Okay, so what you can do, you can buy an option of it. Okay, so that option price for that piece of share will be around like 20% of 3000 will be like 600 rupees. So you can buy that piece of share if you believe it will get increased. So the strike price of that contract will be like there will be a multiple contracts, like the price will be like 3000, 3100, 3200. So these are the strike price, and the expiry date will be like it will be the last Thursday of every month for monthly contract, and there are weekly contract also. So there are multiple contracts are available with the expiry. Okay, so this is called option. Okay, and the term option refers to a financial instrument that is based on the value of underlying securities. Okay, if you are buying the equity derivative, then it will be equity derivative. And if you buy index like bank nifty, then it will be that index derivative. Similarly for exchange traded fund also. Okay, each options contract will have a specific expiry date by which the holder must exercise their option. So if you bought the monthly option, then at the end of the day, okay, you have to close it on the expiry. Otherwise, before the expiry, you can sell it on the secondary market. You can trade it. Means somebody can buy it from you. Okay. Otherwise, on the expiry, it will have to get exercise. That I will explain in detail what I mean by this exercise. Okay. The stated price of an option is also known as the strike price. Now, what are the option types? Okay, there are basically two options. One is call option, the other is one is put option. So call gives the buyer the right, but not the obligation. Okay, to buy the underlying asset at the strike price specified in the option contract. So when the investors think they believe the price of underlying asset will increase, okay, so they buy this call option. This is called call option. And put option is something, put option gives the buyer the right, but not the obligation to sell the underlying asset at the strike price specified in the contract. The writer of the put option is obligated to buy the asset if the put buyer exercise their option. Okay. So in call option, the obligation was not with the buyer, it is with the seller who bought the call option. And in case of put option, the obligation with the seller. So investor buy put when they believe the price of the underlying asset will decrease and sell puts if they believe it will increase. Now let's understand about the buying call option. Okay. So the buyer of a call option pays the option premium in full at the time of entering the contract. Afterward, the buyer enjoys a potential profit should the market move in his favor. So when the market price of the underlying goes up from the strike price, the buyer will have the profit. Okay. So there is no possibility of the option generating any further loss beyond the purchase price. Purchase price means the premium. This is the one of the most attractive features of the buying option. Okay. So for the a call buyer, the maximum loss will be the premium, but the profit will be unlimited in case of buying a call option. If the spot price of the underlying asset does not rise above the option strike price prior to the option expiration, then the investor loses the amount they paid for the option. So his premium will go, whatever the premium he has paid. However, if the price of the underlying asset doesn't exceed the strike price, then the call buyer makes a profit. If the underlying asset does exceed, okay, so if the price of the underlying, so suppose as I give you the example of TCS share, suppose the in the spot market, okay, or in the spot market means when we are buying the equity share at 3,000 rupees, okay, but we bought the options share because we didn't have that much margin in the, or we wanted to buy more share so we can get more profit. Suppose we have 1,200 rupees in our account, okay, so we cannot buy 3,000 rupees of TCS share from that. So what we have done, we have bought two shares of uh, two shares of TCS in options, okay. Okay, so when once there is an increase in the underlying market, like the spot market, like it goes from 3,000 to 3,100 rupees in the spot market. Okay, so the option price also get increased, like the option value also get increased. So we can take the profit from that. Okay, as I give you the example of two shares of TCS, but that is not true because this option you have to buy in a lots. The lot will be like 100 shares you have to buy, 175 share into buy, 175 share you buy. Okay. So the amount of profit is the difference between the market price and the options strike price multiplied by the incremental value of the underlying asset minus the price paid for the option. Selling and a call option. So selling call option is known as writing a contract, also called as the writer of the option who sells. The writer receives the premium fee. Okay. So the call buyer will give this money to the seller. Okay. The call option seller downside is potentially unlimited. Okay. His profit is limited, but the uh, loss will be unlimited. As the spot price of the underlying asset exceed the strike price, the writer of the option incurs the loss accordingly, equal to options buyer profit. Okay. In this case, when the spot price goes more than the strike price, then the option seller will have the loss. The option seller profit is the amount of premium they receive for the option. So what the call option seller think about, like he feels like if the option, like the market price shouldn't go beyond strike price, they wait for it. If the prevailing market share price is at or below the strike price by the expiry, the options expire worthless for the call buyer. Okay, and vice versa. Now buying the put option. So put options are the investment where the buyer believes the underlying stock market will fall below the strike price on or before the expiry date of the option. Since buyer of put option want the stock price to decrease, the put option is profitable when the underlying stock price is below the strike price. Suppose like we have purchased the TCS, like which the current market price of TCS is 3,000. Okay, and we have purchased the TCS put at 3,100. Okay, TCS put of the strike price of 3,100. Okay, so what buyer thing is that from buyer perspective, the stock price, like which is trading at 3,000 rupees, should go down. So if the stock price go down, it will increase the value of the option, which is at 3,100. Suppose the option of 3,100, put option of 3,100, we buy at 85 rupees. So its premium get increased by 95. Okay. So the difference is like 10 rupees. So if we bought 175 shares of TCS, then we will have a profit of 1,750 rupees. Okay. So if the prevailing market price is less than the strike price at expiry, the investor can exercise this put. They will sell shares at the option's highest strike price. Okay. So the risk of buying put option is limited. So whoever is the buyer, like in the call side and the put side, the loss is limited. Okay. And the profit is unlimited. So the selling put option. So selling put option is also known as the writing a contract. A put option writer believes the underlying stock price will stay the same or increase over the life of option, making them bullish on the shares. Okay. So the writer's maximum profit is the premium. The option isn't exercised because the option buyer wouldn't sell the stock at the lower strike share price when the market price is more. This is just the opposite of the like buying the put option. So what is mean by in the money? Okay. So this is basically when an option possesses an intrinsic value. So the option will have a premium. Okay, if I give you the example, like we have bought 3,100 of uh, call option. Okay, so the premium is suppose 75 rupees. So there is a one model, black shoe model, okay, which gives like what should be the premium, which calculate the option premium value. So suppose it is coming 65 or 60 rupees. Okay, so this, but when you are going to buy on some broker, okay, it shows around 75, 85 rupees. Okay, so that extra money like 10, 15 rupees, it is because of the extrinsic external factor. So the option will have intrinsic value and also the external value. So option that is in the money is an option that presents a profit opportunity due to the market relationship between the strike price and the prevailing market price of the underlying. And in the money call option means that the option holder can buy the security below its current market price. So that is called in the money. Okay. So in call option, the option holder can buy the security below its current market price. And in the money put option means the option holder can sell the security above its current market price. In the money option contracts have higher premium than other options that are not in the money, like at the money or out of the money. A call option is in the money, the stock current market price is higher than the option's strike price. Okay. Suppose we bought at 3,100 strike price. Call option is at 3,100. We paid the premium and that time the TCS share price is 3,050. in a spot market. Okay, so we bought 3100 call. Suppose this money, this if the spot price crosses the 3100. Now the spot price is suppose 3150 rupees. Okay, so now the current market price is greater than option strike price. Okay, so the amount that an option is in the money is called the intrinsic value. It means the option is worth at least that amount. So the premium which comes like when we have buying the call option, it was suppose 85 rupees. Now after like the market price has moved from 3050 to 3150, the premium get increased. Okay. And now it is in the money, that is stock, that will be in the money, that option. The difference between the strike price and the current market price is typically the amount of premium for the option. Okay. But this is not the right case because the external factors also come. Like if there are more demand, then the price of that in the money call option will get increased. So the investor looking to buy a particular in the money call option will pay the premium or the spread between the strike and the market price. An investor holding call option that's expiring in the money can exercise it and earn the difference between the strike price and the market price. Whether the trade is profitable or not depends on the investor total transaction expense. So even in some case, like even uh, if it is in the money, suppose the 3100 call option which we bought, okay, and the market price exceeded that level, like it comes at 3100, 13 rupees or 14 rupees, okay, which is more than the strike price, but the difference or the premium which we have paid, okay, is is not able to get that much of amount. So we have not done the profit. So that is not always the case. Like if it is in the money, it will be a profit. Okay. ATM and OTM options. ATM is like at the money, out of the money option. When the strike price and the market price of underlying securities are equal, the option is considered as the money, at the money. That is ATM. Option can also be out of money, meaning they have no intrinsic value, only the external. So when you check the option chain on NSE, okay, you will see even the out of the money having the value. So that is not intrinsic value, that is external factor value, extrinsic value. Okay. So an ATM call option would have a higher strike price than the market price of the stock. Okay. Conversely, an OTM put option would have a lower strike price than the market price. Since an OTM option has less value than ITM option, it usually will have a lower premium. Now, what is the intrinsic value and the time value? So, intrinsic value of an option at a given time is the amount the holder of option will get if he exercise the option at that time. In other words, the intrinsic value of an option is the amount the option is in the money. So it definitely like intrinsic value will be like we can find it out through the black school model, but the extrinsic value, which is the extra amount value of an option, is dependent on the demand. So if the option is out of the money, its intrinsic value is zero. The intrinsic value of call is like max of zero minus strike price minus uh, minus K. Okay. This is the spot price is ST and K is the strike price. So spot price should be greater than the strike price in case of call option. Okay. Then only the like when if it is in the money, then this is the case of the spot price will be greater than strike price. Similarly, the intrinsic value of put is come like 0 comma k minus 60 when the strike price should be greater than the spot price. Time value of option. In addition to the intrinsic value, the seller charges a time value from the buyer of the option. This is because the more time there is for the contract to expire, the greater the chance that exercise of a contract will become more profitable for the buyer. Okay, so the seller will charge, as the seller charges the premium. So this premium will be more when there is a more time to expire that contract. Okay, this is the risk for the seller, and he seeks compensation for it by demanding a time value. A time value of an option can be obtained by taking the difference between its premium and its intrinsic value. So both calls and put have time value. An option that is out of the money or at the money has only time value and no intrinsic value. As I said, the external or extrinsic value, which is comes through because of the time. Okay. Usually the maximum time value exists when the option is ATM. The longer the time to expand, the greater is an option's time value. All, all else being equal, at expiration, an option has no time value. Now, to buy this, like as I said, like you require a margin in your account. So I'm going to explain the margin. What are the kind of margin you should have when you buy an options? Okay. So for option, you require two margin. One is the initial margin. Okay. The other one is the exposure margin. Okay. So span margin and the exposure margin. This span plus exposure margin is also called as initial margin, which is collected when entering a position. Okay. So what do you mean by this span margin? The span margin is calculated on a portfolio. Okay. So there could be like a futures and options, only futures. Okay. This margin calculation is carried out using a software called SPAN, Standard Portfolio Analysis of Risk. Okay. So how this SPAN calculate this margin? So this is use based out approach to arrive at margin like mm, so it is basically on the basis of the price of the security in the cash market and the volatility of the security in the cash market. From these factors, this span calculated, span margin get calculated. Okay. To put it simply, the span generates about 16 different scenarios by assuming different values to the price and volatility. Okay. For each of these scenario, possible lot that portfolio would suffer is calculated. The span margin required to be paid by the investor would be equal to the highest loss the portfolio would suffer in any of the scenarios considered. The maximum loss can be occurred, so that is being considered in the mind while calculating the analysis or risk. Okay, so the margin is monitored and collected at the time of placing the buy and sell order. So the buy margin are revised 6 times in a day. Okay. So once at the beginning of the day, 4 times during the market hours, and finally at the end of the day. So we receive these 6 files. Okay. While approving the trades, okay, while approving the trades, obviously the higher the volatility, higher the margins. In addition to initial uh, span margin, like this one, exposure margin is also collected. Okay. So what is mean by exposure margin? The exposure margin is basically the extra cushion. Okay, extra cushion. So exposure margin is fact of index futures and index options. Sell position is 3% of the notional value. Okay, exposure margin for index futures and index option selling is 2% of the contract value, spot price and the lot size. For stock futures and option selling, it is 3.5% of the. Okay. Yeah, this one is correct for stock futures and option selling. For stock option selling, it is 3.5%, and the third line is correct for exposure margin for index future index option selling is 2%. You can the 3% was is not correct. The second one. Okay. After that, the new SEBI circular mandates broker to collect the complete span plus exposure margin to carry forward futures and option position on to the next. This is the margin required for taking the trade. Span margin plus exposure margin. Next is how this settlement happens of this option. So there are basically two settlement. One is daily settlement, the other one is final settlement. So in the daily premium settlement, the buyer of the call or put option is obliged to pay the full premium towards the purchase of the option. So that is the advantage for the call option call buyer, that he only has to pay a premium one time. Whatever the loss he will make, it will be that premium only, not more than that. Okay. So the premium will be received by the seller of the option and is the maximum profit that the seller will make and compensate for the risk taken. Normally, when the daily premium settlement is done at the level of clearing broker, the total premium payable and total premium receivable are netted against each other to arrive at the final figure of the net premium payable or receivable. So the in case of seller, the amount which a seller pay for the option, it will be more, like it is kind of uh, around 20-30%, but not at the same as like the call buyer. He only have to give premium, which is very less. If I give you the example of, suppose you are buying option of option of 2 or 3 lakh rupees. So for that, you might be giving from the buyer side, you might be giving uh, premium of around 10,000, 15,000. But for seller, he will have to pay at least amount 50,000 of, like around 20-25% of the from the notional amount. So how this daily premium settlement works? So premium settlement is cash settle, okay, and settlement style is premium style. The premium payable position and premium receivable position are netted across all the option contract for each clearing member at the client level to determine the net premium payable or receivable amount at the end of each day. So the netting will be done. Okay, here the clearing member who have a premium payable position are required to pay the premium amount to NSC clearing, which in turn pass on to the member who have a premium receive position. This is known as a daily premium settlement. Clearing member are responsible to collect and settle for the premium amount from the trading member and their clients, clearing and settling to them. So basically, uh, in this daily premium settlement, the amount is collected from the client, okay, who is the buyer, and also from the seller. Okay. And then from the respective trading member, it will come to clearing member. And after the clearing member doing the netting, they will give it to the NXC clearing. And after the netting, the clearing give will give the instruction, like the obligation instruction. Whoever will be the receiver, the like the final netted amount will get a transfer. Now, how this final exercise happen? Final exercise settlement. So the final exercise applies to, like, final exercise happen only on the expiry day. Okay, and it applies to only the contract which is in the money. So that's why I told you about in the money, out of the money, at the money contract. Okay. So all the out of the money position will automatically expire worthlessly, and in such case, the buyer loses the entire premium and the seller earns the entire premium. In the case of all the in the money options, they are deemed to be exercised. and automatically assigned to short position in option contracts with the same series. This assignment is done on the random basis. So this is an important part of settlement process for option. Okay, so all the in the money has to be like exercised on the expiry date, which is automatically assigned to the short position. So for index option contracts and option contracts, index option contract and the stock option contract or in securities, exercise style is European. So previously, like it was the American style and European style. So for American style, they can exercise even before the expiry. But in India, we nowadays don't uh, look after the American style options. We only check on European style. With the options available is only European style, which is what exercise only on the option expiry date. Okay. The final exercise is automatic on expiry of the option contract. Okay, in the money contract. Option contract which have been exercised shall be assigned and allocated to clearing members at the client level. Okay. Exercise settlement is cash settled by debiting and crediting of clearing accounts of the relevant clearing member with the respective clearing bank. So for the final settlement, loss profit amount of for option contract on index is debited credit to the relative clearing member clearing bank account on T plus one. And there are two types of settlement happen. One is cash settlement, one is physical settlement. Mm. Previously, like before 2020, only they used to be a cash settlement, but after that, the SEBI has told the broker to do the physical settlement also. Okay. So in case of this, this this comes because like there was so much leverage was given to the client from the broker side. Okay. So So in case of physical settlement, there is a delivery of the underlying asset in order to close the agreement. Under such circumstances, the party holding the call option purchase the underlying security and the put option holder sell it to a predetermined. But for the cash settlement, the option holder gets a cash payment which is equal to the contract value either before or on the date of expiry. Thus, there is no physical delivery of the underlying asset in the case. This settlement process is generally applicable for the option contracts which have commodity, foreign exchange, stock market, and so you might have thought about like how the settlement happens for the seller side. Okay. So suppose you seller side means like for the buyer side, the buyer has done the buyer has sent give the premium to the seller on the trading day. Suppose on the next day, the buyer gets like buyer is in the profit, okay, and seller is in the loss, okay. So seller has already given option plus exposure. So till the exposure is there, it will not like the broker will not going to ask the seller to give more money. Once the exposure get over, like exposure get utilized, there will be a margin call for the for this for the margin call from the broker side, okay, to put more money uh, into the account. Otherwise, if the client doesn't fulfill that needs, the seller will the broker will sell the square of the position of the seller, okay. And if from the buyer side, the profit, whatever the profit he gets every day, okay, from the seller, it will not be realized profit. Like it will look into the PNL statement, but it will get settled only once the trade get like if he sell that option to somebody else in the secondary market or at the end of the day, like at the exercise day. Okay. So that's all from my side for the option. Like I tried to give the information from my side. But if you have any doubt related to options, you can comment on it and I will create a separate video for that. And also, like, I have not explained the Black-Scholes model, like, which is for the option pricing, how the option pricing been done. So for that, I will create a separate video. Thank you.